Hi there. If you earn money through Deliveroo, Uber Eats, or Stuart, understanding the trading allowance could help you stay compliant.
In January 2025, HM Revenue and Customs processed its first massive influx of earnings data sent directly from digital gig platforms. Independent contractors writing for Deliveroo, Uber Eats, and Stuart now operate within a transparent system where every payout is recorded and reported to the authorities. To understand how to protect your income in this environment, we need to deconstruct the 2026-2027 fiscal framework, the strict rules of the £1,000 trading allowance, and the impact of the new 55p mileage uplift. The mechanism for this oversight is the OECD Model Reporting Rules for Digital Platforms, or MRDP. This flowchart tracks the new legal mandate. Platforms compile your quarterly transaction data and report it directly to HMRC. Inside the compliance folder, you see the precise data points transmitted, your total payouts, exact transaction counts, and specific bank account details. The burden of proof has inverted. HMRC no longer relies on you to declare your existence in the gig economy. They already possess the receipts. This split-screen timeline illustrates a structural flaw causing immediate compliance issues, the temporal mismatch between platform reporting and UK tax law. Notice the red arrows crossing between January and April. Because platforms report on a calendar year and tax returns use a fiscal year, comparing the two sets of records creates phantom discrepancies in cash flow data. HMRC's automated risk profiling software detects these exact timeline discrepancies, which then triggers automated compliance letters to couriers. And this digital reporting is just the first step. The next phase is making tax digital for income tax self-assessment. By April 2026, making tax digital becomes mandatory for sole traders with over £50,000 in qualifying income. By April 2028, that threshold drops to £20,000. Under these rules, the annual tax return is replaced by a requirement to submit quarterly digital updates to HMRC, utilizing simplified three-line accounts for income, expenses, and profit. Because detection systems are fully automated, relying on rough estimates at the end of the year will fail. Couriers must adopt rigorous, software-backed financial tracking. The Trading and Miscellaneous Income Allowance is a statutory gateway. It determines whether you even need to enter the formal self-assessment system. This block visualization exposes a widespread misconception. The £1,000 threshold applies exclusively to gross income before any expenses are deducted. For example, earn £800 from casual delivery with £200 in expenses. Your gross is under £1,000. Expenses are irrelevant. You owe no tax. However, the moment your gross income hits £1,001, you cross the statutory threshold. You must declare the income, regardless of how high your expenses actually are. Confusing gross revenue with net profit is the most frequent mathematical error low-earning couriers make, leading directly to accidental tax evasion. Another major myth is the belief that couriers are entitled to a separate £1,000 allowance for each app they drive for. This Venn diagram illustrates HMRC's single trade classification. Performing the same core activity across multiple platforms is legally classified as one unified trade. The trading allowance is capped tightly per taxpayer per year. It aggregates all casual income into a single £1,000 bucket. But the fastest way to lose the allowance entirely is falling into the employer exclusion trap. Consider an operational scenario. You earn £900 from various gig platforms, but you also accept £50 from your PAYE employer for helping out on a weekend. Because of HMRC rules, that £50 employer connection instantly disqualifies you from using the trading allowance for that year. Your entire £950 becomes fully taxable. The trading allowance is rigid. A single structural mistake or an overlapping income stream from an employer invalidates your protection entirely. Once a courier registers for self-assessment with income over £1,000, a decision tree dictates their next step, choosing partial relief. As the toggle switch indicates, these methods are mutually exclusive. You deduct the flat £1,000 or your actual expenses. You cannot claim both. The optimal choice shifted significantly in May 2026, when the Chancellor announced an uplift to the Approved Mileage Allowance Payment, or AMAP. For the first time in 15 years, the rate for cars and vans jumped from 45p to 55p per mile for the first 10,000 miles. Crucially, this was backdated to April 6th, covering the full 2026-27 tax year. However, the policy contains a sharp environmental contradiction. Approved rates for motorcycles remain frozen at 24p and bicycles at 20p. For car and van couriers, this 10p uplift alters the tax efficiency matrix. It makes precise mileage logs more valuable than the standard £1,000 trading allowance. This comparative ledger models a typical baseline scenario. A courier drives 8,000 miles for platform deliveries, incurring £3,900 in actual vehicle costs. Using the AMAP method, we multiply 8,000 miles by 55p, yielding a flat deduction of £4,400. By comparing that £4,400 deduction against the £3,900 in actual costs, the mileage rate provides a hidden tax shield worth 500 extra pounds. Now, compare the maximum trading allowance of £1,000 against the £4,400 mileage deduction. The strategic takeaway is clear. While the flat trading allowance is highly efficient for bicycle couriers, drivers operating cars and vans lose money using it. In 2026, a meticulous mileage log represents the most lucrative tax strategy available to gig drivers. Administrative precision now yields direct financial returns. The landscape has hardened. Automated platform reporting is live, the trading allowance aggregates your gross income, and the new AMAP rates demand active mathematical optimization. Please note, the information provided in this video is for educational purposes only and does not constitute professional tax, legal, or financial advice. Navigating these thresholds requires precision. Pro Tax Accountant provides bespoke, compliant tax strategies tailored specifically for independent contractors, SMEs, and logistics startups. Protect your earnings and stay ahead of HMRC automation. Call us, send an email, or visit our website to schedule a consultation today. And don't forget to subscribe to our channel for more expert financial insights.